What's up, guys? So on today's video, I'm going to be going over the differences between an IUL and then a whole life policy, the way you structure it with an infinite bank. I've been going down this rabbit hole lately, just trying to decide whether or not the IUL is a good product or not, or whether to just do a whole life when you're talking to clients. So I put together a little PowerPoint just to kind of go through everything that I've found when it comes to these products. I'm not anti-IUL, but I do think in a lot of scenarios, it's not actually the best product for us to be using when we are working with clients. So I kind of wanted to go through everything that I found out and how everything works, just so you can fully understand, because a lot of claims when it comes to IULs they're true, but they're also false at the same time. There's a lot of different stuff in an IUL that I'm not necessarily a fan of, but at the same time, when it comes to whole lives, there can be some drawbacks on that. So I just wanted to put this together just so you guys could have an idea if you are new to this type of product, and so you can better understand it. And if you have any questions about this type of product or anything, just let me know down in the comments, and I'm more than happy to answer any questions you guys have. So first, we do need to understand what this product is, okay? So first, we're going to look at whole life. Obviously, whole life is going to be a permanent policy that we do put in place, and it lasts your whole life. It's very, very straightforward. Now, when we look at premiums, they're going to be fixed throughout the entire life. While an IUL is technically fixed, it's not actually fixed because there's a cost of insurance, okay? Death benefit, obviously guaranteed. Cash value, pretty much guaranteed. Obviously, there's dividends on top of that. But typically you're looking at a guaranteed rate of return when you look at it. So their guaranteed figure as compared to an IUL actually will outperform. It's only when you get into the non-guaranteed assumptions that it will do worse, okay? When it comes to dividends, they pretty much always pay them. But at the same time, they're not, quote, guaranteed, but insurance carriers have always paid dividends. So next, we're gonna look at the IUL itself, okay? Now, an IUL, by definition, is going to be, first, it's underwritten like a term life policy. So when you understand that, it's an annually renewable term up until age 121. So you have to remember the cost of insurance when you apply for term. If you're talking to people about term, obviously the older they are, the more expensive it is to insure. So you do need to understand that it's that type of product. So when we look at this type of stuff, obviously we have flexible premiums that can be adjusted. When we look at those flexible premiums, typically we don't want to tell them that it's flexible, just because if you underfund the policy, the issue you're going to run into later is it's going to pretty much just swallow itself. So when it comes to flexible premiums, I just wouldn't avoid them. Death benefit, obviously you can either fix it or have it decreasing, increasing, whatever you want. Typically, if somebody's talking about an infinite bank, which is what I'm more concerned with when we look at an IUL, typically you want to have that death benefit not go up, just because the risk to the insurance carrier is lower. Therefore, the rise in the cost of insurance is going to be pretty much fixed. Okay. Now, next is going to be cash value growth. Now, obviously, this goes off index. There's a lot of indexes. When you look at IULs from different carriers, this is kind of the biggest issue that I'm seeing. A lot of people are looking at different products, they're saying this is better, etc. Typically, on everything I've seen, IULs that perform the best are the ones that people meet with their clients annually to go over what index they want to actually be in. Okay, so when you're looking at different things, just know that if you don't want to do that, that's fine. But when you look at it, typically the best performing ones are going to be something like that, where you can change it every year and you meet annually to kind of understand where to go. Okay, so an IUL is just going to be a lot more hands-on as opposed to an infinite bank with a whole life. So obviously cash value grows based on the percentage index, subject to caps and floors, so you can't lose money. But obviously if it goes up too high, you're not going to participate if it goes up 30%. So next, let's compare these, okay? So when we look at a whole life, we're going to be fixed to an extent. So you're going to have your floor, and then you're going to have the dividend. So those two, you're typically teetering around 3 to 6%. It depends what carrier. that you're looking at, but typically you're looking anywhere from 3 to 6 with the addition of the dividend. Okay, predictability from a whole life, I mean, it's probably the most predictable of them all. It's been around for a very, very long time, so you don't really have to worry about anything happening from that instance. Now, this is kind of the biggest one that I've seen is carrier responsibility. So when you look at a whole life, since you're having the cost of insurance spread over your entire life, the insurance carrier is the one that assumes that risk. Okay, they're guaranteeing the cash value growth and death benefits, so the risk is actually on the insurance carrier, typically when it comes to underwriting, and they're fixing that cost of insurance. So they can't come in if you're 70 and something happens and raise your rate. So the risk is on them to insure you. Okay, now obviously when you look at stability, whole life is always going to be more stable than any sort of IUL. Now when we look at IUL and its growth, okay, index based, so you're going to have to pick what index you want to put in, so it's kind of like a game of picking the right one. Caps and floors, I've pretty much gone over this. You know, typically if you had a floor of 0, or typically it's like 0.25, you leave it there, and then obviously it can go up higher than that. Now, potential growth, and this is one that a lot of people talk about, is what is the growth potential from a whole life as compared to an IUL? Well, while it can give you a higher potential growth, typically a lot of the IULs that I've been studying and seeing, typically they're getting about 5 to 6% over their entire life, right? When we move into a more higher interest rate environment, that can pose an issue if the market goes down and you hit floors at the wrong time. That's kind of the issue, because again, you as the policy owner, you're the one bearing the risk in this, because if you look at the underwriting, right, since the cost of insurance goes up, they're already anticipating that it is going to cost more money. So the risk ends up going on yourself, and not actually, there's less risk for the insurance carrier. So one of the reasons why you're seeing this a lot more is it takes a lot more risk off the insurance carriers. So that's kind of where we see this product come in more. Now, obviously you're going to be capped. Flexibility to premiums. Anytime I talk to anybody about these types of products, while there is flexibility, don't use it. Just because with an IUL, for it to work, you have to have excess cash in there. So later on, when you do need to use that policy, you're going to be able to use it. Now, finally, when we kind of look at this, I just wanted to give a quick breakdown of what this stuff looks like. Okay, first one, whole life. It's the most predictable of them, and that's why I like it. I don't like to use life insurance as an investment. I like to use it as a savings tool. So for that, predictable growth, guaranteed death benefits, stable premiums, lower growth potential, but at the same time, we're using that money to be used. So that's an easier way to look at this type of product. Don't look at it as an investment, look at it as a savings vehicle that's always going to be there. An IUL, obviously, if you want to look at for an investment, that's on you. I don't recommend an IUL for an investment, but obviously you do have a higher growth potential. You get the flexible benefits and the higher death benefit. So if you're going after a death benefit and you need something permanent, you could probably look at an IUL. I would just do your due diligence on your carriers, because again, since the risk is on the client himself, the insurance carrier technically doesn't have to follow through with the contract if the cost of insurance ends up wiping out the policy. Obviously, the downside is the variable rate of return. Just because in the event if you hit a down for too long, you are not going to be able to cover that premium, and then at that point that policy lapses. So that's kind of a breakdown of an IUL versus a whole life. If you guys like this type of video, please like, subscribe. Give me any comments below whether you like this type of video or if there's any automations you guys want to see. Other than that, I'll talk to you guys next week.